told you there's this powerful strategy, though it's often pretty complex, that corporations use to, well, drastically cut their tax bill. We're talking about a financial maneuver that can literally turn losses into powerful offsets. It can make internal financial flows, almost disappear from the taxman's view. It's a real game changer for how these big corporate families manage their bottom line.
Oh, absolutely. For
Mhm.
many corporate groups, figuring this out isn't just about ticking compliance boxes. It's really about fundamentally optimizing their whole financial structure and achieving, significant tax efficiencies that can directly boost their profitability, sometimes by millions. It's well, a genuinely sophisticated tool that can unlock some serious value.
Okay, so today we're taking a deep dive into consolidated tax returns. It's a fascinating and, frankly, incredibly strategic area of corporate finance. We'll unpack what they are, who gets to use them, and really critically, how they can lead to those substantial tax advantages. But also, what are the maybe unexpected complexities involved? Because this isn't just about filing forms, right? It's more fundamental.
Exactly. It's a fundamental shift in how a group of companies can be viewed for tax purposes. Our goal today is really to unravel the mystery. We want to show you not just what consolidated returns are, but how they can seriously change a company's financial game. We're aiming for that clear aha moment, seeing how all these pieces fit together to unlock real value.
Okay, so if this is such a strategic move, what are the ground rules then? Who actually gets to play this game? Because it's not just open to everyone, is it? We often hear it described as a privilege rather than a right. What's really behind that distinction in the corporate tax world?
That's a great question and really does highlight the selective nature of this strategy. When we say it's a privilege, it's not just, fancy jargon. It's the IRS basically acknowledging that a genuinely integrated corporate group acts like one economic entity, even if it's technically made up of several separate legal entities. So the privilege isn't just about the tax breaks themselves, it's the tax system kind of catching up to the reality of how these businesses operate. It lets them treat their internal financial flows differently, almost like different departments within a single company might. And this recognition helps prevent, a sort of penalizing double taxation for operations that are truly unified. It's definitely not a default option that just any group of related businesses can choose. Instead, it requires meeting very strict criteria laid out by the Internal Revenue Service. And crucially, it demands explicit consent from all the involved parties within that corporate group. And this isn't just a one-time decision either, it's really an ongoing commitment. The actual election to consolidate, which includes filing a consolidated tax return itself and typically attaching Form 1122, which is basically the subsidiary's formal way of saying, I agree. All that has to be done by the parent corporation's extended tax return due date. Now, just filing the return itself often counts as consent, but Form 1122 is usually included just for clarity and solid compliance. This whole structure makes sure that all the members are fully aware of and agree to the pretty significant implications of filing this way.
Right. So if it's a privilege, who gets invited to this exclusive club and who's kind of left out in the cold? Are there specific types of companies that are intentionally excluded? And if so, what's the thinking behind those exclusions?
Absolutely. The privilege is quite specific. It's primarily aimed at certain kinds of profit-generating, domestically structured corporate groups. And yes, there are specific types of corporations that are denied this privilege. Understanding these exclusions helps kind of define the boundaries. For instance, S corporations are out.
Okay, why is that?
Well, because they have a fundamentally different tax structure,
Yeah.
altogether a pass-through structure. Their profits and losses go directly to shareholders, avoiding that corporate-level tax.
Yeah.
So their tax identity is already unique. Then you have foreign corporations. They're also excluded, mainly because of the immense jurisdictional complexities. Imagine trying to consolidate income from different countries with different tax laws, all under one U.S. consolidated return. It'd be an administrative nightmare. So it's just too complex.
Makes sense.
Most real estate investment trusts, or REITs, they're also generally denied this privilege. They already get special, favorable tax treatment designed specifically for real estate investments, which aims to avoid double taxation anyway. They have their own sort of carved-out tax regime. Similarly, certain insurance companies and most exempt organizations like nonprofits are excluded too, again, because of their unique regulatory and tax statuses. So these exclusions really highlight that consolidated filing is a tool crafted very precisely for a specific model. Multi-entity, for-profit domestic corporate groups operating under unified control.
Okay, so the key term here, the one that defines who can participate, is affiliated group. What does that actually mean in the eyes of the tax code? It sounds like it's much more specific than just being, vaguely related businesses.
Spot on. Affiliated group is the absolute cornerstone. It's a very precise definition, doesn't leave much room for interpretation. An affiliated group exists when a common parent corporation directly owns stock meeting, two key thresholds in each of the subsidiaries it wants to include. First, it has to own 80% or more of the total voting power of all the outstanding stock. And second, it must also own 80% or more of the total value of all the outstanding stock of each of those corporations. Both conditions, the voting power and the value, have to be met at the same time. Let's make this more concrete with a classic example. Imagine Corporation A owns 100% of corporations B and C. Okay?
Got it.
Now let's say corporations B and C then own parts of Corporation D. Maybe B owns 60% of D and C owns 40% of D. In this scenario, corporations A, B, C, and D could file consolidated returns.
Okay, why does that work?
Well, Corporation A is the common parent. It directly owns B and C at 100%, way over the 80% threshold for both voting and value. Then, even though A doesn't own D directly, B owns 60% of D and C owns 40%. Since A owns 100% of B and C, D is effectively 100% owned by the group, tracing ownership up through A. This qualifies because the ownership filters down through B and C to D, meeting the direct or indirect ownership rule via a corporate chain. Think of it like a corporate family tree. The common parent is the patriarch or matriarch, and all the branches are other corporations.
That brings up a really important point then. Why is that common corporate parent so crucial? What if, say, an individual owned two separate companies, 100% each? Why wouldn't they qualify?
That's a fundamental distinction, really. It boils down to tracing the ultimate control and economic interest through a single taxable corporate entity. That's why brother-sister corporations, as they're sometimes called, don't qualify. So take the example. Olinto, an individual, owns 100% of both corporations A and B. In that case, A and B would not qualify to file consolidated returns.
Even though one person owns both entirely.
Right. Even though Olinto owns both completely, there's no common corporate ownership between them. Neither A nor B is 80% or more owned by another corporation. The tax code is specifically looking for that hierarchical corporate structure, where one corporation sits at the top. This structure allows for a unified financial picture of what's considered a single economic enterprise from a corporate perspective, not just from an individual investor's perspective. That distinction is fundamental to the whole concept. It's about the legal construct of corporate ownership, not just shared human ownership.
Right, okay. But the real power, the big draw for consolidated filing, often comes down to how it handles financial losses, doesn't it? It seems like a game changer for many companies, letting them leverage what might otherwise just be, dead weight on their balance sheet. How does this loss utilization actually work?
You've absolutely hit on the biggest draw, maybe the real magic trick of consolidated filing. It's taking losses from one part of the business and immediately putting them to work against profits somewhere else in the group. Think of it like a giant corporate bucket where all the individual companies' financial results get poured in. So if you have one subsidiary that's really profitable, generating significant income, but another subsidiary is currently running at an operating loss. Now, if they're filing separately, that loss might just sit there. Maybe you carry it forward, hoping to use it later, but there's no immediate benefit. However, with consolidated filing, the operating losses of that struggling corporation can directly offset the operating profits of the profitable one right there in the very same tax period.
Wow, okay.
This immediately reduces the group's overall taxable income and therefore its tax bill. It prevents what we sometimes call wasted losses. And it works similarly for capital losses too. Capital losses from one member can immediately offset capital gains generated by another member. That's a huge advantage, especially given how strict the rules are for using capital losses when companies file separately.
So to put it simply, it's like the entire corporate family gets treated as one single unit for tax purposes, letting them share resources effectively, instead of a struggling subsidiary just, carrying forward its losses indefinitely. It can actually benefit the whole group right now in the current tax year. That sounds like a massive cash flow advantage.
Precisely. If you step back and look at the bigger picture, it's all about optimizing the overall tax burden of the economic unit, rather than just looking at each legal entity in isolation. It leverages the group's collective financial performance. And it's not just about current year losses either. Think about net operating losses, or NOLs. An individual corporation might have an NOL carryover from a prior year, maybe from before it even joined the group. That NOL carryover can still be applied against the income of the consolidated group in a future year.
So past losses aren't wasted either.
Exactly. It further enhances loss utilization and gives them long-term tax planning flexibility. It's a powerful way for the whole group to benefit from the past challenges of one of its members, turning those past losses into immediate tax relief against current profits.
Okay, let's talk about money moving within the corporate family. Normally, when one company pays dividends to another, those dividends can be taxed, right? But with consolidated returns, something special happens that sounds like it prevents, well, a double hit for the same dollar of profit.
That's another critical benefit, absolutely. When a corporate group files a consolidated return, any dividends received by one member from another member of the same consolidated group are 100% eliminated from the consolidated income. We call these intercompany dividends.
And why does that matter so much?
Well, it prevents multiple layers of taxation. Think about it. Without this elimination, profits earned by a subsidiary would be taxed at the subsidiary level. Then, when those profits are paid out as dividends to the parent, they could be taxed again, and potentially even again if they move to another member down the line. That would be incredibly inefficient and, frankly, punitive for integrated corporate structures. By eliminating these intercompany dividends, the income is effectively taxed only once when it's initially earned by the group. It ensures that just moving cash around within this defined economic unit doesn't trigger extra redundant tax bills. It really fosters efficient internal capital allocation. It's just a very logical treatment for an integrated enterprise.
Beyond the losses and dividends, are there other ways consolidation helps optimize deductions and credits? It sounds like having that larger combined income pool could open up possibilities that individual companies just wouldn't have on their own.
Absolutely. That larger combined income pool is definitely key for certain things. Certain tax deductions and tax credits often face limitations when they're calculated at the individual company level. But these can be much better utilized when the limitations are applied based on the overall consolidated group's income. Basically, the group's higher combined income means higher ceilings for certain deductions, allowing them to be fully taken more often.
Can you give an example of that?
Sure, a perfect example is charitable contributions. If we look ahead to the calculation example we'll discuss later with corporations A, B, and C. In that scenario, Corporation C paid $40,000 in charitable contributions. Now, if C were filing on its own, its deduction would be limited to 10% of its standalone taxable income, which worked out to be only $30,500. So $9,500 of those contributions would have been essentially wasted for C in that year, or maybe carried forward, but no immediate benefit. However, when C joins the consolidated group, those contributions get reevaluated at the group level. Because the consolidated group's combined income is much higher in our example, it's $957,000 before certain deductions. The 10% limitation for charitable contributions also rises dramatically, up to $95,700.
Ah.
So this allowed the entire $40,000 that C paid to be fully deducted by the consolidated group. It perfectly illustrates how that larger combined income allows for significantly greater use of deductions that might otherwise get capped at the individual entity level. It's really about leveraging the scale of the collective for maximum tax efficiency.
It also sounds like consolidation offers some flexibility on when you recognize certain income. That could be a real cash flow benefit for businesses, letting them manage their tax payments maybe more strategically.
It definitely can be. Another strategic plus is the ability to defer income from certain intercompany sales between group members. So let's say a manufacturing subsidiary sells a product to a distribution subsidiary, and they're both in the same consolidated group. The gain that the manufacturing sub would normally recognize on that sale is essentially put on hold, is deferred.
So it's not taxed right away?
Exactly. It's not recognized for tax purposes until that asset, whether it's inventory or raw materials or even a fixed asset like equipment, is ultimately sold outside the consolidated group to an unrelated third party. This can be a significant cash flow advantage. It allows the company to delay recognizing taxable income and therefore delay the tax payments until the actual transaction with an external party happens. It basically aligns the tax recognition more closely with the group's external economic activity, smoothing out the tax burden and giving them more control over their cash.
Okay, so with all these incredible advantages, these tax savings, it just can't be all sunshine and rainbows, right?
Yeah.
What are the downsides? There have got to be some significant trade-off for unlocking such powerful tax savings. Can you give us a sense of how much more complex this really gets? Are we talking like a few extra forms or entirely different systems and maybe even dedicated teams just for this?
You're absolutely right. There's definitely another side to this coin, and it's a substantial one.
Yeah.
The primary disadvantage, really, is the mandatory compliance with incredibly complex regulations. We're not talking about a simple, straightforward filing here.
Yeah.
The IRS consolidated return regulations are, well, they're voluminous and incredibly intricate. They cover everything from exactly how losses are utilized to how every intercompany transaction is treated. Navigating these rules requires highly specialized tax expertise, sophisticated accounting systems, and just ongoing vigilance. It's a whole different ballgame.
So it's not just a small extra step.
Not at all. Imagine your accounting team suddenly needing to track every single internal sale, every dividend, every asset transfer with super granular detail. Not just for financial reporting, but for very specific tax rules. It often becomes a dedicated function within larger tax departments. This isn't just an administrative hurdle, it requires dedicated resources and can be quite costly. Think of professional fees, internal staff time, which, raises that important question. Is the juice always worth the squeeze? Considering these complexities, for many large groups, yeah, the tax savings far outweigh the compliance costs. But for smaller groups, or maybe those with less frequent intercompany activity, the burden might actually start to erode some of the benefits. And within those complexities, the intercompany transactions themselves introduce some quirks that can, well, sometimes be disadvantages. For example, the very first year a group files a consolidated return, there's a potential for double counting of inventory if the group members had intercompany transactions before they started consolidating. Now, this isn't usually a permanent problem, but it requires careful adjustment and reconciliation in that first year to make sure everything's accurate. Another point is, while deferring gains on intercompany sales is a big advantage.
Right, the cash flow benefit.
Exactly. But losses from certain intercompany transactions might also be deferred. So if one member sells an asset to another member at a loss, the tax benefit of that loss isn't realized immediately either. It's deferred until the asset is eventually sold outside the group. So what's a benefit for gains can actually become a cash flow disadvantage for losses because the tax saving from the loss is postponed. It can impact immediate liquidity. And beyond the purely tax-related quirks, there are some pretty significant operational and structural adjustments the group has to make. One of the most impactful, I think, is the mandatory tax year change. Every single member of the consolidated group must change its tax year to align perfectly with the parent corporation's tax year.
Every single one.
Every single one. For a large, diverse group, maybe with international operations or recent acquisitions, getting all those tax years aligned can be a monumental logistical challenge. It means recalibrating internal financial reporting, budget cycles, maybe even software systems across multiple entities just to conform to one single fiscal calendar. It often requires really careful planning, sometimes temporary short-year tax returns for the entities changing their year-end, and it can definitely disrupt established internal processes. It's a significant operational hurdle that needs considerable coordination and investment in time and resources, way beyond just the tax department.
So it's not just about having the tax expertise, but also maybe the sheer manpower and potentially a complete overhaul of internal systems. It sounds like that could be a pretty significant barrier to entry for smaller groups, even if they technically qualify on paper. This isn't just tax compliance. It sounds like deeply integrated financial operations.
You've absolutely hit the nail on the head there. It's a massive undertaking. It impacts everything from budget cycles to internal reporting timelines, might require significant system reconfigurations. It really means a complete overhaul of how financials are tracked and reported internally just to align with that unified tax year. It's definitely a commitment that smaller entities might find cost prohibitive, just given their resources. And then there are also limitations and binding elections that can reduce flexibility down the road. Paradoxically, while consolidation often helps utilize deductions and credits better, sometimes tax credits available to the group might actually be limited by operating losses of other members. This could potentially reduce the overall credit utilization compared to separate filings in some very specific scenarios, especially if the group has significant losses in certain areas. It's a key nuance that can offset some of the advantages we talked about earlier. It requires really careful analysis. And maybe the most significant constraint is that the election to file consolidated returns is binding for future years.
Binding, so you can't just switch back easily.
Not easily at all. It's very difficult to terminate once you've made the election. A group can generally only end this election by, well, disbanding the group entirely, which is obviously a drastic measure, or by seeking specific permission from the IRS. And that permission is rarely granted without a very compelling reason. The IRS really wants consistency once a group chooses this path. So this implies it's not a decision to take lightly at all. It's a long-term commitment with significant implications for future flexibility, strategic maneuvers, even things like future mergers and acquisitions.
Okay. And it seems like the federal rules are one thing, but then states might have completely different ideas, adding yet another layer of complexity here. So, what happens when a company files consolidated federally, but then has to deal with, potentially 50 different state rules?
Precisely. And this is a substantial administrative burden that often catches companies a bit by surprise. While consolidated returns offer those federal efficiencies, many states simply do not allow for the filing of consolidated tax returns at the state level. This means companies often find themselves in a situation where they're filing consolidated for federal income tax. But then they have to prepare and file separate company tax returns for state income tax purposes for each entity within the group that operates in that particular state.
Wow, that sounds like double the work.
It can feel like it.
Yeah.
The consequence is significant additional tax preparation time and expense. You're effectively maintaining two sets of books, or at least two distinct filing methodologies, one for federal, one for state. This can diminish some of the administrative efficiencies you gained at the federal level and definitely adds considerable cost to compliance. It's like trying to put together a giant puzzle twice, but using different rules each time.
Okay, let's unpack the calculation itself. Then this is really where the rubber meets the road. How do you actually calculate the consolidated taxable income for a whole group? It sounds incredibly complex given all these moving parts, the intercompany adjustments. But I know there's usually a method to the madness.
It does sound complex, and it is detailed, but thankfully, there's a systematic five-step framework. It provides a structured way to get to that final consolidated taxable income number. And while each step involves, detailed calculations and adjustments, following this method helps ensure accuracy and consistency. Maybe think of it like painting by numbers, but for taxes. Don't get lost in every single digit right now, but focus on the type of adjustment and its impact. Okay, so the 5 steps are basically, first, you calculate the standalone taxable income of each member, just like they were filing separately. That's your starting point. Second, adjustments are made to each member's income to remove the effects of transactions between members of the group. This is key for not double counting things. Third, you temporarily remove certain gains, losses, and deductions from each member's income, the ones that have to be determined at the overall consolidated level. We're kind of setting them aside for group-level treatment later. Fourth, you combine the resulting adjusted taxable incomes of each member from the previous steps. This gives you the group's overall combined taxable income, like a crucial subtotal. And finally, fifth step, you take that group combined income and adjust it for those items we set aside in step 3, the ones determined at the consolidated level. You essentially reapply them against the combined income. This methodical approach makes sure nothing gets double counted or missed, and that everything is optimized for the group as a whole.
That's a great framework. Okay, now let's try and make the numbers real. We have this example you mentioned, corporations A, B, and C filing consolidated for year 6. B and C are wholly owned subsidiaries of A. Can you walk us through how these 5 steps actually play out with some figures? Show us exactly how those tax savings we talked about might materialize in practice.
Absolutely. This example illustrates the mechanics perfectly. Let's break it down. Step 1. Calculate each member's standalone taxable income. Okay, this is our baseline. We start by figuring out the taxable income or loss for A, B, and C individually, as if they were filing totally separate returns. We look at their gross receipts, costs, gross profit, any dividends received, other income, and then all their deductions, salaries, taxes, charitable contributions, depreciation, etc. So just looking at their individual results before any consolidated magic happens, maybe Corporation A starts with taxable income of $674,500. Corporation B might have a loss, say, $34,000. And Corporation C shows income of $274,500. These are just their standalone numbers. Step 2, adjustments to eliminate intercompany transactions. Right, this is where we start cleaning things up, preventing internal transactions from being taxed or recognized inappropriately within the group. First, let's look at intercompany dividends. In our example, during the year, B paid $60,000 in dividends to A, and C paid $30,000 to A. That's $90,000 total. As we discussed, because these are intercompany dividends within the consolidated group, this entire $90,000 is 100% eliminated from A's income for consolidated purposes. You could visualize it as just reducing A's starting income by $90,000. It prevents that internal double counting. It's just money moving from one pocket to another inside the same corporate family. Second, intercompany inventory profit. Let's say Corporation B sold inventory to Corporation A and recorded a $50,000 profit on that sale internally. For consolidation, this $50,000 profit needs to be excluded from B's gross receipts initially and deferred.
Deferred until when?
Until A sells that inventory to someone outside the group. So we make an adjustment that effectively reduces the group's consolidated gross receipts from this internal profit. The tax on that profit doesn't hit until the item actually leaves the family, so to speak. Third, maybe an intercompany Section 1231 gain. Let's say Corporation C sold a piece of equipment to Corporation B and recorded a $10,000 Section 1231 gain. A Section 1231 gain, for anyone less familiar, is just a specific type of gain from selling business property. Similar to the inventory profit, this $10,000 gain is also removed from C's income initially and deferred. Again, these deferrals are really crucial for cash flow. The gain isn't taxed until the asset leaves the group, aligning the tax recognition with the group's external economic activity. Step 3. Remove gains, losses, and deductions determined at the consolidated level. Okay, now we temporarily take out certain items from the individual calculations because they're better handled when looking at the group as a whole. First, C's charitable contributions deduction. Remember, Corporation C paid $40,000 in contributions.
Right, but was limited standalone.
It's exactly. On a standalone basis, C was limited to deducting $30,500, which was 10% of its individual income. So for this step, we remove that $30,500 deduction from C's calculations. Why? Because we're going to reevaluate it at the group level in step 5, where the limitation will be based on the much larger consolidated income, potentially allowing the full deduction. Second, A's dividends received deduction, DRD. Okay, Corporation A received those $90,000 in dividends from D and C. Those were already 100% eliminated back in step 2 as intercompany dividends, so they don't factor into the DRD here. However, let's say A also received $110,000 dividends from an unrelated company, maybe a domestic company it owns 30% of. On a standalone basis, A would normally take a 65% DRD on this external dividend, which comes out to $71,500, $110,000 by 65%. Similar to the charitable contribution, this $71,500 DRD is removed from A's deductions here in step 3.
Same reason, to recalculate at the group level.
Exactly the same reason. It will be reevaluated and applied at the consolidated level against the group's total income. We're essentially centralizing these specific calculations for optimization. Step 4. Calculate the group's combined taxable income. Okay, after all those eliminations and removals from the individual company levels in steps 2 and 3, this step is basically about getting a subtotal. We combine the adjusted taxable incomes or losses of each member, A, B, and C. After all those adjustments, let's say that taxable income before NOL and special deductions for the combined group comes out to $957,000. This $957,000 is our new baseline. It's a unified income figure for the entire corporate family before we apply those final group-level deductions we set aside. Step 5. Apply adjustments for items determined at the consolidated level. All right, this is where the magic really happens, and you see the true benefit of consolidation for those specific items we pulled out. First, consolidated charitable contributions. Remember, C paid $40,000, but was limited to $30,500 alone. Now, we look at the consolidated level. The contribution limitation is 10% of that combined taxable income of $957,000, which is $95,700. Since the group's actual contributions were only $40,000, all from C, the group can now take the full $40,000 contribution deduction.
So no wastage.
Exactly. That's a direct benefit of consolidation, full utilization of an expense that might otherwise have been partially lost or delayed. Second, consolidated dividends received deduction. That's $71,500 DRD for the dividends A received from the 30% owned company, the one we removed from A's income earlier. Now it's applied here at the consolidated level, calculated against the group's $957,000 income base, subject to its own potential limitations, but let's assume it's fully allowed here. So after all these meticulous steps, applying the now fully utilized charitable deduction, applying the consolidated DRD, and accounting for any other group-level items like NOLs, we arrive at the final consolidated taxable income. In our example, let's say it comes out to $845,500. What's really fascinating here is how this whole detailed process, with all the eliminations, the deferrals, the recalculations, it ultimately funnels everything into a single optimized tax figure for the group. It clearly demonstrates the cumulative impact of these adjustments.
It shows how a consolidated return truly unifies the tax picture and optimizes the overall tax liability for the entire corporate family, rather than just taking a piecemeal approach. This is really where those significant tax savings can be realized by treating the group as that single economic unit.
Okay, that calculation process makes sense, step by step.
Yeah.
Now, shifting gears a bit to the practicalities. When it comes down to actually submitting this return, what form are we looking at? Does it require a completely different set of tax forms compared to a standalone company? Or is it more like a familiar form but with a twist?
That's a great question, and it does speak to some of the hidden complexities. Consolidated tax returns are actually filed using the very same Form 1120 that single regular C corporations use. So at first glance, it looks familiar. However, the key difference is that you check a specific box on page 1 of the Form 1120, indicating that it's being filed on a consolidated basis. But And this is a big but. Don't let that apparent simplicity fool you. What lies behind that single checkbox is a requirement to attach numerous, often complex, supplementary schedules and statements. These schedules detail all the intercompany eliminations we just talked about, the specific calculations for each step, the breakdown of income and deductions member by member, details on the group structure, consent forms potentially, and much more. It's really in these attachments where the true complexity and the additional compliance burden reside. The main form looks the same, but the supporting documentation is exponentially more intricate and detailed. It's kind of like ordering a standard pizza box looks familiar, but inside there might be a multi-layered feast with very specific, complicated ingredients you need to list out. And beyond just the forms themselves, tax accounting methods and periods also require significant alignment within a consolidated group. Generally speaking, the members are usually permitted to continue using the same accounting methods they used before consolidating. So if one subsidiary used the accrual method and another used a specific inventory valuation method, they can largely keep doing that. However, there's an important exception for certain methods that have threshold limitations which must be applied on a consolidated basis. For example, determining if a corporation can use the cash method of accounting might be restricted if the consolidated group's total gross receipts exceed certain limits, even if individual members were below it before. But the really crucial requirement, the one we touched on as a disadvantage earlier, is that every single member of the consolidated tax group must use the parent corporation's tax year.
Still seems like a big hurdle.
Oh, it is. There's absolutely no flexibility on that point.
Yeah, that sounds like a massive undertaking, especially for a large group. What is the logistical challenge there to get everyone on the same accounting period? It sounds like it could impact a lot more than just the tax filings themselves.
It absolutely is a huge undertaking. For large, diverse groups, maybe those with international operations or companies acquired recently with different fiscal years, aligning all those tax years can be a monumental logistical challenge. It means potentially recalibrating internal financial reporting cycles, budgeting timelines, maybe even ERP software systems across multiple distinct legal entities just to conform to that single fiscal calendar dictated by the parent. It often requires really careful upfront planning. It usually involves filing temporary short-year tax returns for the entities that are changing their year-end, which adds complexity in the transition year. And yes, it can definitely disrupt established internal processes and rhythms. It's a significant operational hurdle. It needs considerable coordination, time, and resources, stretching well beyond just the tax department. Imagine trying to get, say, a dozen independent businesses, each with its own established financial rhythm, to suddenly start marching to the beat of a single drum, dictated by the parent. It's quite an orchestration effort.
Right. Okay, so once a group is filing consolidated, what does that mean for their individual tax responsibility? You mentioned the complexity, but what about the liability? Are they all equally on the hook for the entire group's tax bill? Does opting into this privilege mean accepting a kind of collective financial risk?
This is perhaps one of the most critical aspects of consolidated filing, and yes, a significant risk factor to understand. Each member of the consolidated group is jointly and severally liable for the entire consolidated tax liability.
Jointly and severally. What does that mean exactly?
It means the IRS can pursue any single member of the consolidated group for the whole amount of the group's tax bill. This includes not just the tax itself, but also any associated tax penalties and interest. So even if one specific member was profitable, had correctly reported all its own income, and contributed very little to the overall group tax liability. If the group as a whole defaults on its tax payment, or maybe another large member becomes insolvent and can't pay its share, the IRS can legally collect the entire outstanding amount from any other solvent member.
Wow. So one company could end up paying everyone else's share?
Potentially, yes. It's like a family taking on a joint mortgage. Everyone who signed is responsible for the full amount, regardless of who earns more or less, or who's living in the house at the time. This is obviously a powerful incentive for strong internal due diligence and maybe even robust intercompany agreements about how taxes will be allocated and paid internally. It ensures all members are aware of, and hopefully mitigating, this shared risk. And related to payments, there's a specific rule for estimated tax payments too. For the first 2 consolidated tax return years, the group has some flexibility. Estimated tax payments can be computed and paid on either a separate company basis or on a consolidated basis. This gives them a bit of breathing room during the initial phase as they adapt to the consolidated system. However, starting with the 3rd consolidated tax return year, the estimated tax payments must be made on a consolidated basis. No more choice. This shift kind of reinforces the idea that once a group has committed to consolidated filing for a couple of years, they're considered fully integrated from a tax standpoint, and their estimated tax obligations have to reflect that unified financial picture. But that underlying joint and several liability remains. It's a critical risk factor and, as I said, a powerful incentive for internal controls and collective responsibility within the group. The financial health and compliance of every single member directly impact every other member.
Okay, so we've definitely taken a deep dive into consolidated tax returns today. We've uncovered this really powerful strategy that allows these affiliated corporate groups to optimize their tax burden, primarily by sharing losses effectively, eliminating those intercompany dividends, and leveraging deductions on a much grander scale. It's truly a strategic move that can dramatically reduce a company's overall tax payments by essentially treating the whole corporate family as one unified entity for tax.
But as we've seen, that privilege absolutely comes with significant complexities. It's not a free lunch. You've got the intricate compliance requirements, the mandatory changes in tax years, which can be operationally challenging, and that really substantial joint and several liability for the entire group's tax bill, which is a major risk factor. It really is a strategic trade-off. The benefits of efficiency and potential tax savings have to be balanced against that increased administrative burden and the shared financial risk. The decision to consolidate isn't just about the immediate tax savings. It's really a long-term commitment that fundamentally reshapes how a corporate group operates financially and legally.
So, as you, our listeners, consider the intricate world of corporate finance, maybe think about how these kinds of strategic decisions, even ones that seem really technical, like choosing a tax filing method, can dramatically reshape a company's entire financial landscape. What other areas of business, maybe operations or strategy, might hold similar sort of hidden opportunities for optimization? If only we were willing to really deep dive into the details and truly understand the nuances of the rules that govern them. Sometimes understanding the rules of the game is the key to unlocking massive value.
Exactly. I think the takeaway here isn't just about tax forms or specific regulations. It's more broadly about understanding how the established rules of the game, whatever game you're playing, tax, finance, operations, can potentially be leveraged for significant advantage. Provided, of course, you navigate the complexities with the right expertise and foresight, it really highlights the power of knowledge, of deep understanding in unlocking value. Not just in tax, but really across any operational or financial domain, where a detailed understanding can yield powerful strategic benefits. It's about seeing that bigger picture and truly understanding how all the different pieces connect.